120. Before the war started back in late February, that is exactly how many ships passed through the Strait of Hormuz on a normal day. 120 massive vessels, just steadily keeping the global economy's lifeblood pumping. It was absolute clockwork. But if you're not paying close attention to what's happening in that waterway right this very second, you are completely missing the single most powerful force driving your portfolio today.
4. Just 4 ships. That's the number that crossed the strait yesterday. From 120 all the way down to 4. This breathtaking collapse in maritime traffic is, without a doubt, the absolute most important macro variable on the planet right now. It's the hidden gear turning the whole shebang. It explains why inflation just spiked, it explains the sheer panic happening at the Federal Reserve, and it completely explains why the cost of capital is violently repricing. We are watching a true economic earthquake here. And this drop to 4, that is the exact epicenter.
Okay, let's dive into the Hormuz chain reaction, covering oil, inflation, and the Fed. Welcome to today's Explainer, where our goal is simple but honestly pretty massive. We're going to trace a $1 trillion chain reaction that literally nobody saw coming. And so far, nobody has been able to stop. We're going to break down exactly how geopolitical friction, thousands of miles away, is currently doing the Federal Reserve's job for it. So here's our roadmap for today. We are tracking a 5-link chain. First up, the Strait of Hormuz. Second, crude oil. Third, the Consumer Price Index. Fourth, the Federal Reserve. And finally, the 10-year Treasury yield. All right, starting with link 1, the choke point, the Strait of Hormuz. It is honestly wild to think that a waterway barely 21 miles wide at its narrowest point controls roughly 20% of the world's oil. I mean, that is a full third of all seaborne crude. But ever since the United States and Iran went to war on February 28th, this vital artery has been functionally closed to commercial traffic. Now, sure, technically a truce opened it up in mid-April, but let's be real, commercial captains aren't exactly lining up to test waters where missiles and drones are still actively flying. And here is why you really need to care about this. The CEO of Saudi Aramco issued a stark warning last week. He straight up said that if the strait stays effectively closed past mid-June, the global oil market will not fully normalize until 2027. Think about that. Even if ships started moving freely today, it would take months just to rebalance the system. Let's move to links 2 and 3 and see how this builds, the spark and the fire. Naturally, our second link is crude oil. Brent crude spiked about 45% since the war began, touching around $108, and it even hit $114 earlier this month. Now, usually, an oil shock doesn't have to become a full-blown inflation shock, but when we break down the April Consumer Price Index data, it's a different story. Headline CPI printed at 3.8% year-over-year. That's the hottest we've seen in 3 years. Energy alone is up a staggering 17.9%. But it's really the core CPI that is flashing the brightest danger signal. Stripping out volatile food and energy, core CPI still ticked up to 2.8%. The monthly core rate is actually at its highest since January 2025. This is telling us loud and clear, the inflation is not isolated. The fire is spreading. To put that into perspective, seeing core CPI rise like this while the Fed's target remains strictly at 2%, well, it's the macro equivalent of an engineer watching a single warning light come on and then noticing that the heat is starting to spread to all the components right next to it. Energy inflation is bleeding directly into transportation costs, into goods, and into logistics-dependent services. This isn't just some one-off anomaly. We're looking at a fundamental system change. Which brings us to link 4. The Federal Reserve hits a wall. Okay, let me give you another really critical number to keep in your head. 4. Now, this isn't the number of ships this time. This is the number of dissents at the April Federal Open Market meeting, and it is the exact reason why the newly confirmed Fed Chair, Kevin Warsh, is basically walking straight into a trap. See, Warsh was expected by a lot of people to be a pretty dovish chair, someone ready to come in, start cutting rates, and unstick the economy. Instead, he's facing a committee that is utterly terrified. That April meeting produced an 8-4 vote, 4 dissents. That is the largest dissent vote on a Federal Reserve interest rate decision since 1992. I mean, you can probably imagine those FOMC dinners are getting a little tense right about now. This historic gridlock acts as a massive wall. It proves that the committee has made a definitive choice here. They would much rather risk pushing the whole economy into a recession than repeat the disastrous mistakes of the 1970s by easing policy right into a wage price spiral. So even if Warsh really wants to cut rates, he simply does not have the votes to do it. And the market? The market has completely woken up to this reality.
Just think about the dramatic repricing we've seen in futures markets over just the last 4 months. The probability of the Fed actually cutting rates in 2026 has completely collapsed to under 3%, almost zero. Meanwhile, the chance of a rate hike before year-end has surged to roughly 40%. The market realizes the Fed is totally stuck.
And that leads us to link 5, the bond market takes over.
So the crucial point here is understanding a concept called multiple compression. The 10-year Treasury yield recently jumped from 4% to 4.68%. The 30-year is above 5%. Basically, the bond market tightened financial conditions by 68 basis points automatically, without the Fed touching the policy rate even once. When that 10-year yield rises, the discount rate goes up, and that shrinks the present value of a company's future cash flows. The bond market is effectively acting as the true central bank right now, mechanically enforcing tighter conditions on its own.
It helps to think of the 10-year Treasury yield like a load-bearing column in a massive skyscraper. When the yield rises, it transmits all that heavy load to every single floor above it. Let's compare two scenarios. A high-growth software company might be worth 35 times its forward earnings when the 10-year is sitting at 4%. But bump that yield to 4.7%, and that exact same company is worth closer to 28 times earnings. That is an automatic, brutal 20% valuation haircut purely from the interest rate path. And that happens before the company's actual earnings change by a single dollar. This mechanical reality perfectly explains the incredibly violent portfolio rotation we've been seeing since February. Long-duration growth assets, things like AI, semiconductors, unprofitable tech, they are facing severe headwinds and massive multiple compression. But on the flip side, we are seeing huge tailwinds for cash-generative, defensive sectors that have real pricing power. Integrated oil, gold, defense contractors, they're all outperforming. This isn't just about market sentiment or day traders getting skittish. It's the cold, mechanical consequence of a higher cost of capital flowing right through the chain. All right, let's pivot to this steel man, the opposing case. To be completely fair, we have to look at the strongest counterargument here, which is that this entire 5-link chain is really just a one-shot supply shock, not some permanent regime change. The theory goes like this. If the Strait of Hormuz functionally reopens for real by mid-June, meaning ships are actually crossing, not just relying on a paper truce, oil could quickly fall back toward $80 by Q4. If that actually happens, that terrifying 18% energy CPI base effect we're looking at right now completely flips. By April 2027, you'd have a massive disinflationary tailwind pushing prices down, and that would entirely change the macroeconomic landscape. Plus, we really have to remember that the bond market has a pretty long history of overshooting these big regime stories. Just look back at 2018. The 10-year hit 3.2% based on this whole inflation forever thesis. And then what happened? Just 2 years later, that exact same yield crashed to 0.5%. So the lesson here? Anyone aggressively shorting treasuries today, assuming a permanent stagflation is the new normal, is fighting against some very powerful base effects and historical base rates. It is a dangerous game to just assume the shock lasts forever. So that brings us to the crossroads. 2 clean tests. And this brilliantly illustrates exactly what you and I need to be tracking over the next 6 weeks. Test 1. If Brent crude stays above $100 a barrel through July, the regime change is completely real. The Fed is absolutely trapped in a box, and the bond market is 100% right to be pricing in some serious pain. But then there's test 2. If Brent falls below $85 by July, it means the Hormuz supply is actually coming back online. The math flips, the CPI normalizes by year-end, the Fed gets the cover it so desperately needs to finally cut rates, and all that growth stock multiple compression reverses. Oil is literally the single highest information variable right now. So let's just briefly recap this absolutely stunning reality we're living in right now in May 2026. The market is doing the Fed's job for it. 4 ships crossing the strait became a 45% spike in crude. That became a 3.8% CPI print. That forced the 10-year yield up to 4.68%, which instantly triggered a 20% multiple compression on growth equities. This massive economic tightening all happened mechanically, without the central bank hiking a single time. Until oil normalizes, make no mistake, the bond market is your central bank. So I'm turning it over to you. Which test do you think is going to win out in the end? Will Brent hold above $100 through July, cementing this wild new stagflation regime? Or will it break below 85 and give the market a massive sigh of relief? Get in the comments and let me know your thoughts. I read every single one of them. Tracking this one variable is all you really need to do right now to understand where trillions of dollars are moving. Thanks for joining me for this explainer. Keep learning, keep watching the data, and I will see you next time.